Welcome everybody to another easy algo training. It is Monday today, and today we are jumping into the Indicator X training. This is one of the indicators that I'm going to focus a little bit more on the Mondays because it's also such an amazing indicator. And we've been focusing a lot on TrendX, which is very important for the new people to start on TrendX. TrendX is a bit more of a beginner-friendly indicator, and I think and I recommend everyone to start on TrendX first. And once you get the hang of it, once you really understand how it works, and then you can start to play around with Indicator X, because Indicator X is a powerhouse of an indicator. Really, I haven't even, a lot of the people in the group haven't delved in too deeply into it, and I haven't been focusing too much on it just because I don't want to overwhelm everyone. But I'm going to start every Monday going a bit more deeper into Indicator X, just showing you how it works, because Indicator X is not just an indicator, it's also a methodology. It's a methodology, and it's a methodology that's based on accumulation and distribution. It's based on supply and demand. So today I'm going to go a little bit over that methodology with you, and then take you onto the charts and show you how the methodology actually plays out in the market. Because for us as a trader to become successful, it's not really about learning how to trade lines. Also, the main aspect is understanding the psychology of the players in the market, understanding the psychology of what is actually happening in the market. Who is moving the price? Why is the price moving? How is it moving? All these details. If we can understand what is happening in the background, for most traders, especially retail traders, we're operating in the foreground, in the front ground. But if we can understand what is actually happening in the background, it can give us a better perspective, a more wholesome perspective about everything that's going on within this trading. So today I'm going to go through exactly some of those, and I'm going to tie them in with Indicator X and just show you how Indicator X is more than just an indicator. 95% of traders lose in the markets. And in order to win, you must do what the 5% of the winners are doing. So this is a very obvious statement. And the key is, what are those 5% of the market doing who are winning? Market makers have a method for how they buy and sell their inventory. So you see, the market makers are the ones who are moving the market. They're the ones who are entering with the super large position sizes. They're the only ones who can actually move price. And they have a very specific method about how they buy and sell their inventory for profit. And since they are moving the market, you as a trader, you want to learn how to emulate their trading strategy. So how do they accumulate and how do they make profit are extremely valuable questions that if you have the answers to that, will help you trade in alignment with these big players. Successful predictions make successful trading. This is the key. Number one, who has the power to move the market? Number two, why do they move the market? And number three, how do they move price? So these are very good questions to start thinking about, and even possibly doing more research in your own time. I will share with you my view. But the more we can understand these kinds of questions, the more we can understand what's happening behind the scenes, what's happening within the psychology of the market. Because if we can understand what the true intentions are of the market makers and how they do business, you see, we want to find out, how do they actually do business? Because they have a very structured approach to how they do business within the financial markets. And this happens in any market, whether it's Forex, crypto, stocks, options. It's very similar structure. They're the ones who drive price. They're the ones who have the most to make out of the markets. And they have a very structured approach, which is their business model of how they do things. So who is driving the market? These are the market makers. These are the smart money, whether you call them the institutions, the banks, the hedge funds, they fall into these categories. Why are they moving the market? For profit, for control, for influence. You know, a lot of these very big players, there's so much politics involved around trading that we're not aware of as a trader, because we just, you know, stare at the charts and we just trade. But behind the scenes, on a very large scale, trading is involved within wars on the planet, you know, within political movements. All of these things affect the stock market. And who benefits when the stock market is affected? Political players, presidents, government officials, people who own large portions of the world. So why is also a very good question. And then we've got the how. How does this happen? This happens through accumulation and distribution while manipulating the laws of supply and demand. So since these guys, these market makers, banks, hedge funds, institutions, since they're the ones who move the price, who move the financial markets, they can dictate how they want things to go. So essentially, they're the ones who are in control. They're the ones who are in command of what is happening. And they have the ability to manipulate the price of the market. They can manipulate the assets. They can do whatever they want to do with it. And therefore, us retailers who are just kind of piggybacking on what they're doing on the market, we're the ones who are losing. We fall into the category of that 95% of the people losing in the market, because this is not our game. This is not our business model. They're the ones who drive price. So if we're trading with our own business model of what we think should happen, that's not an alignment with how they drive price, we will end up on the wrong side of the market more often than not. So it only makes sense as a trader to start to understand their business model and how they move the price, how they trade, how they do things in the background. I've spoken a lot about this in my previous price action trainings, and I will continue to talk about it. And every Monday, we're going to go through it more and more and more. I'm going to make sure that we get an excellent understanding of how these market makers trade, their exact business model of how it works. I've spent a lot of time, one of my mentors that I spent a lot of time with, he worked in a hedge fund. He worked in these places for a long period of time. And he shared with me a lot of information about how they actually trade in these hedge funds, what their business model is, how they operate. And I learned a lot of things from him, and just gathering and doing a lot of research. A lot of it is out there for you to research as well. So please dig deeper into the subject matter. It is extremely valuable and will help you understand what is happening behind the scenes in order for us to synchronize with the business model of the people who actually move the market. So over here, I've got a picture for you. And this is just showing you the basics of this accumulation. So they work within a structure of accumulation and distribution. And remember, this is based on indicator X, so I'll be using it as reference points as well, just giving you a very basic understanding now of how it works. And then we'll go into the charts and we can start analyzing the charts according to what I'm sharing with you. Because when you look at the charts, instead of just seeing an indicator, I want you to understand and see the methodology behind it, to understand the psychology behind what is actually going on. Because when you understand the psychology, it gives you a deeper understanding of what is happening, which can help us make excellent trading decisions. So you can see over here, we've got contraction zone, we've got the expansion line, and then we can see price breaks underneath here. So now this is a stage of accumulation when price is underneath. And remember, this is a 12-hour value line. This is a higher time frame chart. So just remember, I'm actually talking about a higher time frames here. So you can see price is broken below the value line, and this is the level of accumulation. Now, every time you see a big sell-off occur, that would be a moment where you want to accumulate. This is how the market makers do it. They're accumulating the whole time price is going down. So what the retailer is doing when price is going down, the retailer is actually selling. But then what the market makers are doing, they're buying that inventory from the retailer who's actually selling it. And every time price goes down, they buy, goes up, you see a big candle down, they buy, candle down, they buy. So they are accumulating their inventory. They're accumulating their supply when price is underneath value. Because when price is underneath value, that is the chances you're going to get the asset at a cheaper price. So these market makers will accumulate, they'll buy inventory from willing sellers. And they'll get into multiple positions because these market makers, they trade with such huge amounts that they can't actually enter in one position. So they have to break down their positions into multiple positions. And this is what they do. They will just purchase, just pieces. And then eventually they will accumulate enough supply in this specific phase, because this is the accumulation of supply aspect. And then as we build onto it, they will accumulate all their supply down here when price is under value. And then when price goes above value, that was when they will start selling their inventory for profit to willing buyers. So everything they're accumulated underneath value, they're going to take profit on that above value. When it comes underneath value, again, they're going to accumulate. When it comes above value, they're going to distribute and they're going to sell that for a profit. So in very, very simple terms, this is how Indicator X is actually working. Because underneath value is where you're going to accumulate at discounted prices. Above value is where you're going to be able to sell what you accumulated at discount prices for a profit. And this is basically the formula in its most simplest terms. Just accumulate when price is at discounted prices and then distribute and sell that for profit to willing buyers. This is the whole process of accumulation and distribution. So if I just break it down into very, very simple terms of how this is actually working, as you can see over here. First of all, we've got a seller over here, and the seller wants to sell 100 shares for $1,000. And this is you over here as the trader. So you want to buy it from the seller because you think there'll be more buyers at higher prices, so you'll buy your shares. You think it's a good investment. And then you sell that 100 shares to an interested buyer who believes the stock is going to the moon, who's willing to buy 100 more shares. So in very, very simple terms, this is how it is working. The seller over here, he's got $1,000 in inventory, which is accumulated by the trader. Then what they do is they sell it to you over here, who's holding period. So you hold those shares until they reach certain levels on the chart, until you're ready to distribute. Then you distribute to someone who thinks it's going to go even higher than where you are distributing it at. And this whole cycle happens over and over. I'm sharing to you in very, very simple terminology just to understand how this is actually working and how it relates to the graph that I just showed you. So your single biggest job as a trader is to consistently make quality forecasts and to accumulate discount inventory and then sell the inventory for profit. So if we just go back to the diagram here, your job as a trader is to calculate on the chart where are going to be the places where you can accumulate inventory at discounted prices, where you can pick up a stock or an asset at a discounted price. And Indicator X, these value lines show you exactly where on the chart. It's the fine line, guys. This value line is the fine line between discounted prices where you can actually accumulate and areas above the value line where you can distribute for profit. So now that I've just shown you these very basics understanding of how it works, I'm going to take you onto the charts and I'm going to actually show you this in live on the charts, how it all works, and also just show you a few other concepts with our strategy. So here we are on the chart. So what I like to do on the chart is, on this example that I've got here, I've got first of all, a higher time frame value line, which I'm just going to turn on. So this value line over here is a 12-hour value line. I like to always use the 12-hour because it's a good enough level to work with. It's a very good and accurate bias of what's happening in the market. So if we're just looking at the chart over here right now, we can see that we've got this value line over here. Everything underneath the value line over here would be places where you would start looking for positions to purchase. Remember, guys, the key here is to understand the business model of how these market makers trade and then learn to emulate that business model. Because the more we can emulate the way they trade, the more we can piggyback on their backs and we can ride the liquidity. Remember, they are the liquidity in the markets. They're the ones who move the price. They're the ones who can drive price like this. So if we can piggyback on their liquidity and we just get in when they get in, we can ride the benefits of their movements in the market. So for instance, over here, you can see on the chart, we've got price going underneath this value line. And you can see the further it goes down, the more we're going into discounted prices. And there's other ways we can interpret this as well. You can see over here, we've got a demand zones. This is why these demand zones can actually be such good confluences to use in combination with indicator X. So as price is dropping down here, you can see, so I'm just going to zoom in so you can have a close look at what's going on. You can see over here, as price breaks underneath the value line. So there's different ways to trade this strategy. And I'm just going to basically go through some psychology of it now. And then I will show you the different strategies that we can use. So for instance, over here, in our strategy that we teach, at this point where price breaks below the value line is going to be the exact place we're going to start looking for sells in the market, for sells. Because we know, if we look at this, we know these are expansion legs. So if we look at this leg over here, it goes up. You can see over here, this is one expansion leg down. That is one expansion leg. And then we make a second expansion leg over here. And then price doesn't reclaim the value line, and then it comes down and makes another leg. And then eventually here, it actually reclaims and gets higher than this value line. It produces its own new structure over here. But this is basically how it works. So this leg over here, if you can see, this is one of the expansion legs over here. This is and we can trade these expansion legs. But at the same time, we want to keep in mind with the initial psychology of what is happening in the market. So for instance, over here, what I originally showed you guys, this would be a place where you would start to look for sells, because on a higher time frame, we know if price is breaking below a higher time frame value line, there's going to be, first of all, an expansion leg down before we get the reversal. Before we get a reversal back to the value line. So on the one hand, we've got to keep the psychology in mind that the further away we get from this value line, the greater the chance that price is going to reverse and go back up to value line. But we can ride this expansion leg down, or at least ride some of it down. So you can see over here, price breaks below the value line over here. And if we had to go onto a lower time frame, sure, we could have caught a few basic scalp trades to this point. But then you can see what happened here. We usually get this happening, guys. When price breaks down, it comes back up to retest, and then we have this drop that occurs. So what we can do is we can anticipate this leg down, and we can ride it or catch a few short positions on the way down. But at the same time, within our psychology, we must understand that the further we go down here, should actually be the places where we should start focusing on accumulating buy inventories. Because sure, we can ride it down, as a flexible trader, you can short the market, you can long the market, short the market, and long the market. But at the end of the day, we just want to focus on the psychology, because the psychology is going to be the most important thing in this training. And for any trader, they say 85% of trading is psychology and the other 15% is just the strategy. So you can see over here, as price is going down. So what the market maker is doing, every time there's a little drop here, they're actually buying inventory. Little drop here, buying inventory. They're just buying small positions, because they've got massive positions. Get a big drop, they buy over here. Get another drop, they buy over here. They're just accumulating a little bit of inventory, because every time price is going down, we have sellers in the market. And remember, these market makers, in order for them to buy and fill their positions, they need to have sellers to buy from. The sellers will sell to them, they'll buy from the seller. So when the market is in the red or going down, that is the best time you can fill your buy positions, because there's enough available inventory. So price is going down. We get a lot of people selling. So there's a lot of people who are selling in the market, and these guys can buy from them. So this is one of the reasons why they're accumulating inventory undervalue, because undervalue is where the retailer are going to be selling, which means there's going to be liquidity on the other end of the market for them to buy from. That's why this whole system is inverted. You see, retailers are all selling under the value line. Market makers are buying under the value line. They're doing the opposite. The smart money is always doing the opposite of the dumb money, always. But I mean, we can still sell underneath the value line, as long as we understand this process of what is actually going on. But from a market maker perspective, they're focused on only buying under the value line. When everyone is selling, they're buying. When everyone is buying, they're selling, because this is how they're changing hands. This is how they're able to have enough liquidity on the opposite side of the market, because if they want to buy, say, $1 million or $1 billion of liquidity, they need someone on the opposite side who's willing to sell $1 billion of liquidity. So what better place than in a seller's market, when the retailers are selling under here, they can start accumulating from all the sales. But within this structure, we've got to keep in mind that the further away price gets from value, the greater the chance the reversal is going to happen. And this is one of the reasons why demand zones can be so great, where we mark out these key levels. Remember, on Thursdays, I do key level training, which is price action trading, which is invaluable to combine with any strategy that you use. Price action is king, first of all, and then everything else we layer on top of that. So in this example, price is going down, we can accumulate. It also all depends on what kind of a trader you are. If you are a scalp trader and you're just looking for like 2 to 3 to 5% per day, then this is a good environment for you to sell. Whenever these prices are going down, you sell. If you want to do more swing trades and more bigger investments, then you want to focus on when price is going down. Like look at this move over here. You see here, whenever you see a big drop like this, these are the places you want to actually start buying. I don't know if you guys have ever heard the saying, buy in the red, buy in the red, sell in the green. So when the market is going down and in the red, that is when we should be buying, where a lot of the retailers are buying in the green. So they'll see a big candle pump up in green and then they'll buy. But the key is when you see a big red candle drop down, that is where you want to start buying, because you're buying into the fear. So remember, guys, everything is the opposite. You want to always do the opposite of what the retailers are doing. The retailers are buying into the green, so you want to buy into the red. They're buying into the FOMO. You want to buy into the fear, which is the red. It's the total opposite psychology. So you'll see in this example over here, we had this big drop for majority of people were panicking. They were proper panicking in the situation. There was fear in the market because anyone who was in a long position up here, they got liquidated completely. But now if we employ the strategy of aligning our psychology with the market makers and trading with the way they trade, these are going to be the places we are going to be looking to accumulate inventory. When we see these big sell-offs, you can see big sell-off, you could accumulate another big sell-off, you can accumulate. If you had accumulated in this region over here, then look at the profits you would have made, because this is how price works. It doesn't travel in straight lines. We get a massive wave down, massive wave up. So if we had gotten in over here, that was a 50% move. If we were accumulating positions, so say we accumulated a little bit over here, a little bit over here, and then over here we started accumulating a few different positions. Maybe we got a drop over there, we accumulated another drop, we accumulated. Remember, this also depends on your trading style. We wouldn't be doing this if you were doing more scalp trading. This is going to be more for if you're doing long-term investments or more swing trading, because these market makers who drive the market, they don't scalp the market because they trade with massive position sizes. So they're only focused on these swing trades or big investment trades, because they can't enter and exit the market wherever they want, like a scalper, just because they have such high position sizes that they're trading with. So I'm just showing you how they do things. The better we can understand how they do things, then when we actually implement our strategy, we can overlay it with understanding their strategy, which can also just help us understand where could be good places. Maybe you want to exit the market, where could be good places that you want to possibly hold your trade for longer, because inevitably every trader should be looking at their trade from a higher time frame first. When you look at your trades from a higher time frame first, and then you make your decisions based on the higher time frame, and then you can zoom in, whether it's going to be mini scalps or mini swings, but then keep zooming out to just have a look. So like, for instance, if you were scalping the market over here and you saw this drop and you zoomed out and you saw price was actually coming into this demand zone region, this is the area where you could have actually stopped your sells, and you can start focusing on buying the market now. So we see another little drop over here. So this is the market maker accumulating. They're filling their inventory. And remember, guys, there's miniature, like I'll show you miniature. I'm putting indicator X on 2 time frames at the moment, just to show you in this example over here. We've got the red is the higher time frame, and the white value lines is the lower time frame. So you can see we've got multiple things happening at once over here. Let me just clear my chart to show you. So you can see as price is coming further down, this just gives us, so what I am on now, I'm on a 4-hour chart, just so you guys all know, I'm on a 4-hour chart. This is a 12-hour value line. This is my major value line. This one is my major value line that I'm following. I'm just going to turn off these liquidity lines just so it can be more clear. This is the main one that I'm following. But then when prices are below here, we've got these mini ones which can help give us more precise entries. So you can see at the bottom over here, if we look at this furthest one over here, and the reason I'm picking this is because, say, for instance, we marked out our demand zone over here. Remember, guys, demand zones are zones where price has a big possibility of reversing. And you can see over here, based on the price action training that I was teaching, we've got breaks and structures to the upside. We've got these big volatility candles. So we mark out these levels. These levels become very, very key levels to look out for, where price can actually reverse. So if we're using that in combination, like I always suggest to use price action in combination with any of the indicators we're using, you can see price comes back to this level. And then we're looking at 2 different value lines. We've got the higher time frame value line over here, which is the 12-hour. And then these little ones are actually the 4-hour value lines over here. And what they do is they just help you get more precise aspects of where value is. So on the one hand, on this value line, price is underneath it over here. And then you can see on this other value line over here, the reason I picked this one because it's touching the exact region of this demand zone. You can see we've got this contraction, which is now a 4-hour contraction. And then we get another area which is undervalued. Can you see over here? This is this area over here. So this region is undervalued. right underneath here. So it's giving us more precise areas because you can see we've got the major area that's undervalued, and then we've got another area that's undervalued. So this becomes a more precise undervalued area. So these would be the areas that we would look to take our long positions because it's giving us, we've got one value line in overlaid with the other ones, just giving us more precise entry locations because we're undervalued on the higher time frame value line, we're undervalued on the 12-hour and the 4-hour value line. So these would be the places to look to enter. And then it all depends, guys. The reason I'm showing this because it all depends on what kind of trader you are. But we're buying, remember, we're always buying underneath value, and then we're selling above value. So as soon as price gets above value, we can start selling our assets. Gets underneath value over here, we're buying the assets. Let me look for more examples. We're buying the assets over here, undervalued. We're buying the assets over here, undervalued, even though this wasn't such a good one. Because remember, the closer it is from the value line, so price broke underneath this value line over here, the closer it is to the value line, the less we want to actually look for long positions. We want to wait for price to come further down because you can see the further price gets away from value, the more of a discount you're going to get the price at. And the greater the chance that price is actually going to reverse and go all the way back up. Can you see this here? Breaks down, moves further away from value, and then it comes back to value. Moves away from value, then it goes back up to value. And this is how it plays out over and over. If you have a look at your charts, if you spend time back testing on indicator X, you're going to see this plays out over and over. And the more we can understand the probabilities of what is going on, the more we'll understand how much the odds are in our favor or not. But in this scenario, as an investor, these are the areas you want to purchase as an investor. And guys, the same strategy applies if you're scalping. You'll just be on lower time frames doing the exact same thing. So it's higher time frames as an investor or swing trader, lower time frames as a scalper. It's basically the same process happening over and over. But the main thing to keep in mind, the further away we get from value, you can see over here as well, the further away we get from value, the greater the chance price is going to come back to the value line. Further away we get from value, comes back to the value line. And it plays over and over again. I mean, even look at this scenario over here. If we pay attention to this value line over here, price goes further and further away from value. Look here. So remember, we've got the macro and the micro further away from value. Then it comes back down to value. Look to touch it over here. So price is going away from value and back to value, away from value and back to value, at least a few times before it deviates away from the value line. So look over here. If we focus just on this contraction box, you can see we got price away from value, back to value, away from value, back to value, away from value, back to value. And then it bounces off and now it starts to deviate away and starts creating more of these value lines. But you can see if we can anticipate, look here, if we can anticipate, it goes away, it comes back. So that's one time it's come back, 2 times it's come back, 3 times it's come back. So price has actually come back to value in this whipsaw, which is the expansion phase. We've spoken a lot about this. It's actually come back 3 times. So we had 3 possibilities to trade back to value, 1, 2, and 3. And you'll see on most of the tokens, you're going to get away with at least 2 times, 3 times that it's going to come back to value. So we can anticipate that. Like for instance, if I just focus on this higher time frame, value line over here, you can see price broke. This is where we got the contraction. The first phase in the market started over here. And then we got price move away from value and then come back and then come back again. So we had multiple opportunities here. We had an opportunity here. It came back to value, moved away, came back to value again, moved away, came back to value again, moved away, came back to value again. You can see this plays out over and over. These lines are magnetic lines that attract price. So there's multiple ways we can trade them. We can wait for price to get further and further away from value, as in this example over here. We wait for price to get further and further away from value. And then we know the further away it gets from value, the greater chance is we're going to have this rotation back to the value line. As price is getting further away, we can use other confluences, like what I've used in this example, as demand zones, supply zones, certain structural points, usually at these swing low points, which are these regions over here. These are swing low points. These are good regions to pay attention to, where we get these possible reversals, because first of all, we can see we've got a squeeze happening over here. You can see squeezes are happening. And so we're followed by these explosive moves. You can see, so I always trace wherever we see a big explosive move, you always want to trace the origin of that move, which was right over here. And you want to find the last down candle before the up move. And look here, this is an indecision candle, which I speak about all the time. So we can trace it back to that specific location. And then when we come to our charts, keeping in mind this methodology of the further away price gets from the value line, the greater the chance of reversal. And then we can anticipate there's a higher probability price is going to reverse at these demand zones or specific key levels, which we can find in many different ways. We can use Trendex to find them. We can use price action to find them. So that when price is coming back to these regions, these are the regions where we want to start accumulating our inventory, anticipating that there's going to be a time where price is going to suddenly now reverse back to the value line. So if you had accumulated inventory here, here, and here, you would have got a very good position. And there's a few other ways to do this. You can see over here, it's amazing. Whenever I look at the charts, and guys, I didn't rehearse this before, and I just grabbed a random chart so I could show you this. So you can see we've got the same thing happening over here. Price comes down. If we didn't want to just randomly enter when price came close to the demand zone, we can use one of the formulas that I was sharing in last week's training, where we just wait for breaks and structures to the upside over here. You can see we suddenly got a break in upstride. So this could have been an area where you would look for a long as well on this break in structure, or we wait for price to come back, and you can see we're marking out another demand zone, or another demand zone here. So price comes back, and then we can tap into this region. But remember, all of this is keeping in mind that we want to trade back to value, back to value. This is our key, back to value, because price, especially on these higher time frame value lines, price loves to go back to value. And if you can see, if we zoom out a little bit now, you can see price comes up, and then at this point over here, this was the area. If we just extend this line, sometimes I just extend these lines, guys, because it can just allow you to see a bit better. Let me just make this as thick as the last one. So I just extended that line, and now you can see these are the locations above here where the market makers are now selling their inventory. Remember, they accumulate inventory underneath the value line, and then they sell inventory above the value line in these locations, or in their way to get it up, and they sell over here. So everything they accumulated in the green over here, then they're going to suddenly sell in the red. And this is their business model. Their business model is accumulate inventory at discounted prices, which is undervalued. So this value line, guys, this value line is a tool. It is a methodology that is very much linked to the psychology of what I'm explaining to you about how these market makers trade. This is their book of business. This is where they balance their books at this level. This is the 0 point level. So every time you see a value line, just imagine this is the reset point. This is the 0 point where the market maker resets their book of business, or the 0 point from which they trade upon. So keeping in mind this methodology, it can give you an upper hand when you trade, because now you can know that the probability of price going back to the value line is very high. If you were down here and you were trading, you know that price wants to get back to value. There's a high probability. If we had to backtest, there's probably a 70 to 80% chance of price coming back to value, coming back to value, coming back to value, because this happens because this is how the market makers trade. They want to accumulate at the bottom here, and they want to drive price above value. This is their goal. And so what we want to do is we want to emulate their strategy. We want to trade with their strategy in mind. We want to understand that this is the way they're doing things, and we want to keep that as a data point, as a structural point to place our probabilities on top of. Because remember, as I explained in the beginning, your success as a trader is going to be based on how accurately you can predict the probability that something will go in the favor or direction you intended it would go into. So this is why we can use these value lines as great tools to help with these predictions of what is going to happen. So in this example over here, prices move far away from value. We know it's away from value. So we know what are the market makers going to be doing now. We know that they're going to drive the price back up. And there's other strategies we can use along with this process. You see, so we can mix many different processes into the mix. Number one, as I showed you, we got demand zones. Great. So now it gives us an area to look for where there's possibly this reversal. We can anticipate price further where it gets, the greater the chance it's going to go back. And what we can also do in this mix, we can use other price action. So you can see over here, we can see prices making these lower highs. I'll show you over here. At these precise areas over here, you can see we've got lower high, lower high, lower high. So we can see this uptrend is starting. So we can even add that into the mix, and this could be a place to enter. This could be a place to enter. So when we get lower highs in combination, you can see over here, we got another 12-hour value line formed. So this area over here would have been an excellent place to enter or to re-enter your trade. This would have been an excellent place over here as well, because you can see we've got another demand zone being formed in this region. We've got breaks in structures happening up here. We've got these big momentum candles occurring, so everything is telling a story. And the more we understand all these little moving parts, the more we can put them together, and we can be able to read the story that's being told. But at the base of it all, it's the psychology of what is actually going on. Because if our psychology can understand what is the true psychology of the market, this will give us more confidence in our trades, as well as understanding price action. So price action is the key for your actual base and structural of how you're going to trade. And then the psychology of how the market makers trade is going to be overlaid on top of that. So when you think about all these things and you keep them all in mind at the same time, that's when you can begin to make incredible trading decisions and feel more confident in your trades, and just understand what is actually happening in the background with these market makers. Because at the end of the day, we just want to synchronize with the market makers. We want to think like they do. We want to trade like they do. We want to enter like they do. The more we can understand their reality of how they do things, the more we can synchronize with how they do things, the better our trades are going to be. Because remember, they are driving the market. They are moving the market. And this is going to be our key with hopping on. They're already creating a wave. Imagine they're creating a wave. You're just a little surfer and you're hopping on the wave with them. You're riding the wave that they've created. Because there's a saying that that I learned a few years ago, which really opened my eyes, was, first of all, you don't want to be the liquidity in the market. You want to ride the liquidity in the market. So don't become the liquidity in the market, ride the liquidity in the market. When you are selling, remember, you're not buying from the retailer, you're selling to the retailer, because the market maker does things differently in the market. So we want to synchronize with them as best as we can. So as you can see in this example, I'm going to just grab another chart as well. So when we're looking to trade with Indicator X, there are multiple ways we can use it. And a lot of people ask me, so how do we know which is the best charts to use with Indicator X? And I want to show you guys. So when you're going through a bunch of different coins, there are certain criteria that are going to stand out more than others. And I'm going to show you this today. I don't think I've even gone into too much detail of this. There's just so much to teach. But what we want to do is, when price goes into contraction, when price goes into this contraction phase, and then we get this whipsaw phase out of the contraction box. This is a very, very basic idea of a three-legged of a contraction phase and an expansion phase. Just notice the symmetry of it. Can you see the symmetry of it? We've got a nice expansion leg. Look, we've got a nice expansion leg going up, then down, then up. This is very symmetrical in its form. Now, I want to show you one that is not symmetrical so you can understand the difference. This is going to be one that is not symmetrical right now. We've got the basics happening here. We've got price forming contraction, and then we've got a non-symmetrical one forming over here, which is kind of like this kind of thing. And then you can see we've got a value line coming out the center. So what I'm proposing that can help you in this scenario is we want to look for expansion legs that look very symmetrical over here on a higher time frame. Because when we get symmetrical expansion legs, remember, we want to capture these expansion legs. We want to take advantage and capitalize off the expansion legs. If we get an asset that has a very symmetrical structure, of how it's doing things like this, just, very symmetrically doing things, these are going to be the best ones to look for. When we get this kind of thing happening over here that's just kind of dropped down, we don't know, there's no like reference point showing us of the asset and how well it's performing. So when you're flipping through the charts and you're looking, say for instance, you want to trade with indicator X and you're looking for symmetrical movements, you can see this doesn't look too bad because you can see it looks symmetrical. It's gone up, down, up, down. We can see this constant up and down back to the value line. So I'll pick a few more just to see if we can spot a really good one for you guys. So you can see over here, this one is not that symmetrical because it kind of drops behind. This is not to say you still can't trade the formula, guys, because you can see over here, once again, we've got the same thing happening. We've got a fair value gap over here. This is actually all a fair value gap region. So you can see as price is coming down to these fair value gaps, these are areas we want to look for reversals to occur. We can see price goes further and further away from value, and then we get a rotation over here back to value. So this is the region specifically over here. We want to look to enter our long positions back to the value line. And the same thing happens here. Price comes back down. You can see over here, if we mark out this region over here, it's the swing low areas over here. Remember in my previous trading, I said always follow the wicks. So you can see over here, look, we've got all these wicks over here. I'll just mark out specifically. Wait, actually, let me mark it out with a box so I don't confuse you guys. So you can see we've got wicks over here. Let's give a nice border. I always follow the wicks. The wicks tell a story. Look, you can see. Remember, I said before in my price action training, follow the liquidity. The wicks are the liquidity, and you can see every time price came into this box, we had a reaction. We had a reaction. So if we had to keep that in mind on top of the strategy with these wonderful value lines, we can know when price comes into these liquidity regions over here and over here, there's going to be a retracement back to value. So these are going to be the areas we want to look to accumulate inventory, and our target is going to be back to value. So we can use the value line as a magnetic level of where we can anticipate price is going to be pulled towards. So magnetically, price gets further away from value, and then it gets pulled back to value. Gets further away from value, then gets pulled back to value, further away from value, and it gets pulled back to value. You can see this happening multiple times here, and it doesn't matter how many charts you go onto, you're going to easily see this process happening over and over again. So with this in mind, just looking at it from the psychological higher time frame structural point, we'll just give you a reference of where's going to be the best places to look for trades. And if you get into those trades, where is our target? Where is price most likely to be going to be pulled back to? So there's a few different ways to use these value lines. Let's keep looking at a few other examples. See the same thing happen over again. Moves away from value, comes back to value. Moves away from value. And you can see over here, if we just mark out our demand zones, I'll show you this in a few assets, and then you'll see how how frequently it actually happens. This is a demand zone. And then we've got a miniature demand zone over here. And each time price came back down here, you can see accumulated inventory back to value, comes below value, accumulates inventory back to value. So I love using supply and demand, like I said in the beginning, because the key is accumulation and distribution with supply and demand. So the value lines are showing us a very easy tool to learn where accumulation is happening under value, distribution is happening above value, and then we're using our supply and demand areas where here is a demand zone, here is a demand zone on top of that. So when we combine supply and demand with accumulation and distribution, these are the kind of effects that we actually get happening over here. So if we enter, we can just trade back to value, which is the safest place, back to value, or wait until price gets above value. But you see in this situation, it didn't even happen. It reached a high point over here. And this is exactly where price decided to reach a top in the market. There we go. It topped out over here. We got a double top, you can see. And we know double tops are also bearish signs. And then we get this massive drop in the market. So this is why you always want to combine price action on top of everything you're doing. I'm going to be doing my best to teach you price action as best as possible. You can see in this scenario over here, we've got the contraction zone, first phase in the market. Then we've got the expansion legs happening, all these expansion. Remember, guys, I'm on a 12-hour time frame, on an extremely high time frame. But I just wanted to show you the structure of how this works on a higher time frame. Because if we understand, guys, our first step in mastering any strategy is understanding the bias and understanding what is happening on the higher time frame. We always want to start on the higher time frame first, mark up our key levels, our price action levels. If we're using indicator X, we want to observe what's happening on the higher time frame. And then after we've done that, after we understand where we are positioned on the higher time frame, then we can zoom in onto the lower time frames and we can start trading accordingly. Like you can look over here. Okay, if I zoom in now, so like I'm zooming out and looking at this whole chart, you can see we've got one cycle playing out over here, one contraction, we've got another cycle playing out over here, we've got another cycle playing out over here. But at the same time, they're all working together. So if I mark out this is a very evident demand zone over here. You can see right over here, because we had this explosive move up, we got these break-in structures. So what I do, I mark out the indecision candle, and look at that. If I mark it out, look how many times it relates to further future price action. Taps in over here, we get a reversal. Taps in over here, we get a reversal. Taps in here, we get a reversal. Taps in here, we get a reversal. So once we can zoom out, we can see these key price action zones. Here we can find another one over here. Remember, we got wicks. So I mark this area here. Look at that. So this is showing us the supply and demand flip, the support and resistance flip. So over here, this region over here was previous resistance. And then it flipped it over here. It flipped it multiple times. Then it becomes support over here. 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 So you can see we've got a support and resistance flip happening over here. This is why why it's so important to combine our price action on top of our indicators, whether we're using indicator X, whether we're using trend X. This is so important for us to do it. And then based on that, we know if I zoom in over here, we know the likelihood of it reversing is at this demand zone. So then I keep this demand zone in mind. And then I also keep in mind that the value line is positioned over here. This is the value line. And the further away price gets from value, the greater chance it will reverse. So you can see price gets away from value and it reverses back, gets away from value. And now it looks like it's actually coming back to value. So right now, if we look at this, we can see we've got these highs being broken over here. So remember, guys, like another great tool I like to use to figure out where price is going to, like where would be the best price to enter here. The best place to enter would be if price breaks above here, find support on this level, because remember, this is the previous high. This is the previous high. If price can break above that high, that's a good place to enter. I'm actually just going to show you this to you, structurally how it works. So say, for instance, Price forms a level over here, it breaks above it. This is going to be the area where we want to look for an entry, because remember, this is our support and resistance flip. And then chances are price comes back to retest it and then carries on going. This is a very good entry model you can use. I always use this. It's such a good model to use because we got resistance. You can see we got resistance here. We've got resistance. And then suddenly the resistance is broken over here. When the resistance gets broken, it's showing you now that there's a change in supply and demand that's happening in the market. It oftentimes will break it. It'll come back to retest it. So what was previously the roof over here, this was previously the roof, then it all of a sudden becomes the floor over here. This is another analogy that we can use to anticipate. So we can use this strategy in many different locations. We can use it on higher time frames. We can use it on lower time frames, and we can use it at key levels. So it's another region that happened over here. You can see, and if we zoom in on lower time frames, we'll probably see this happening multiple times in this region as well. See, if I zoom in on a lower time frame and I just clear this away, you'll see it happens in many different areas. Here's a miniature version of the same thing happening over here. See, it breaks above, then it finds support, then it goes higher. And if we zoom out, you can see we've got the same thing happening here. So it's like, it's the same thing happening over and over. Here was a support, here was a support, and then price breaks below, and then it becomes a resistance. So we have to keep that in mind as well, because if our target, so say for instance, let me clear this away. Say for instance, this is our demand zone down here. So we know there's a chance price can reverse at this area, but then our overarching target is going to be this value line. And sure, price is going to get back to that value line. We just don't know when. So we can accumulate inventory, we can pick up assets here at a good price. And then if we're waiting for price to come back to this level, it might not come back straight away. As you can see in this example here, I'll show you there's two locations. It didn't make it here. It didn't make it here. But maybe now, this time round, it's going to make it. You can see here. Now, this time, it could actually make it to this level. So it also depends how long you want to wait, because if we look here, if we entered over here, and then we've waited over here, this is already 12 days later. But if we wanted to get smaller trades, if we wanted to still trade up and down, remember guys, if you were purchasing here and you were holding to this level, you would have look what would have happened. You would have purchased here, you would have gone into profit, you would have lost that profit. You would have gone into profit, you would have lost that profit, and now you would have gone into profit again. So a wise thing to do in this scenario, if you're just a long-term investor and you're just planning on holding, accumulating, so the market maker, the reason this happened, because they're accumulating, and now they are going to sell when price gets above the value line. This is where they're planning to sell. So the chances of it getting above here are very high. We just don't know when. These market makers are extremely patient, and they use patience as a tool to make you make the wrong decisions. So oftentimes, if you hold on to a position for long enough and you start to get very doubtful, you start to get uncertainty, it's because patience is something they use to their advantage to make you make bad decisions. But if you still wanted to capitalize on this, there's many things you could have done. You can see over here, look here. If we look very carefully at this region over here, we've got supply zone over here. So if we'd marked out the supply zone, we know we can just play from demand to supply, anticipating that the initial outcome area is going to be at value or above value. Because you can see, came up, came down. And if we had probably jumped onto another time frame, you're probably going to see what we've actually got a value line in the center over here as well. So remember, we've got value lines within value lines. We've got value lines on the macro, which is this, the red line. And then we've got value lines on the micro, which have been the green over here. And then it plays out. Otherwise, you can see over here, we've also got another region You can see it breaks down. So like the more we can combine these key levels on top of these value lines, the more we can get a stronger reference point. So you can see if we zoom in, remember, like I used to do this for over a year manually before I actually had the indicator. So I'm able to just spot these things because I understand the movement of the market. So you see, if we had to stretch this further, you can see how price is respecting this level. If we look over here, price is respecting this level. So it also becomes a key level as well as a value line. And if we had to imagine it was a value line over here, I'll show you guys. I'm going to show you. This is amazing. I love how it all ties together. If we had to have this contraction box happening over here, there is no contraction, but if we had to extend it, I'm telling you there would be, because we can see, guys, we've got the whipsaw. Remember, if we want to anticipate the phase of the cycle, we can see, look, we've got the contraction, we've got the expansion legs happening here. We've got a multi-leg expansion. Whenever we get this ranging effect, it's actually a multi-leg expansion that's happening. And then because what's happening on the macro is happening on the micro, and then we zoom in on the micro over here, this area underneath here is underneath value where you buy, and this area on top here is above value where you're actually looking to sell. So even though on the highest time frame, our overarching time frame, we're waiting for price to get above this value line, we've got the same thing happening over here. Buy below, sell above. Buy below, sell above. Because remember, we're buying under the value, we're selling above value. So we could have still done the same process multiple times in this time frame, just purely because we understand how this mechanism is actually working. Let's come back and remember this line over here that I drew is a demand zone. So price comes into demand, and you can see, and then it goes above value, we sell, comes into demand, goes above value, we sell, comes into demand, goes above value, we sell. If you wanted to hold to the overarching area, you can see we're in a region right now where it's a resistance point. If you look carefully, you can see price is resisting. See, price is resisting over here. Price is resisting over here. And then now we're coming here to a third time. So what is going to happen? Is price going to resist? Remember, we never know. We can't predict the future. But two things are actually going to happen over here. Price is either going to hit this level and come back, or price is going to break above this level. I'll show you now. Price is going to break above this level and then go up. If price breaks above this level and what previously was resistance becomes support, it'll become support region over here, then we can actually enter this trade again. And anticipating now that it's going to value, most likely above value, because we know the market makers who entered down here, they're going to be cashing in when price gets above value over here. So let's have one more look at one more chart quickly, and then I will open up the floor to some questions. So let's have a look. So let's go back to our 12-hour time frame, and we're just looking at a bunch of them. Like I strongly suggest, see, look at this one. Look how well this one's playing out super nicely. See, guys, it's the same thing happening over and over. We've got our demand zone down here. You can see this one's already marked out because I often just open these up and I open the chart up just like this, higher time frame, 12-hour value lines, and then I just start marking out the supply and the demand zones on top of the value lines, and then you can start to see how things are playing out. Here's another supply zone up here. Why is it a supply zone? Because you can see this is an area where price has found resistance. So there's supply and demand zones, there's support and resistance zones, basically the same thing. You can see resistance. So that's why I mark out this level. And then you can see over here, we've got our contraction box forming over here. Then price moves up. The price moves up into our supply zone. It rejects off the supply zone. So look, this was one of our expansion legs. Expansion leg up, expansion leg down. So we can anticipate that. And look, it passed the value line over here, and then it almost came back to value over here, but didn't quite make it. And then we've got the same thing happening. You can see we can also draw trend lines. Like if you're into trend lines, we've got breaks, retests. We can also use what the formula I just showed you, where if price breaks above this level, because this is a support level, then we can look to take another entry over here. it's going to go further up. So you can see, guys, we've got the same strategy playing over and over. It's below value over here. So we're starting to look for our buys below value when price is getting into demand zones or at key structural points. The reason I saw this as a key structural point is because this is where we got this big movement happening over here. And then I marked out the demand zone. You can see we got this big movement up. When you've got price curling up like that, it's showing extreme volatility. And then we got a small pull back into this other demand zone and then curls up again. So we know when price comes back to this region, you can see if you mark this out like this, you can see, and we mark it out like this, you can see this is a squeeze point. So whenever we get to these squeeze points locations, these apexes, you can see this is the center of the apex. The center of the apex is where we get a breakout occur, which is just showing us also excellent areas to mark out for our demand zones. And then we can trade accordingly. If I just take away a few of these things here, you'll see. Then we've got price coming below value. So as soon as price got below this value line, we can short it down to this demand zone. Once price gets to the demand zone, we can anticipate longing it back to value or back to another zone, which is over here. This would be another zone over here. And you can see there's zones within zones. We can see over here, we've got another zone. So there's multiple ways, and all depending on how you like to trade. If you're an investor, you can get into these positions and hold them until price gets above value, which would be above this value line. If you're just a scalper or mini swinger, then you can just enter and anticipate price is coming back to a supply zone. You can see this would have been the supply zone over here. So these are regions where price got rejected as well. I think the more times that you hear me saying is, the more you go over these trainings, the more you start marking up your charts, you're going to see, guys, price is following a certain sequence, almost like a mathematical formula that it follows, and it repeats the strategy over and over again. So over here, you can see that there's not much movement happening yet. Maybe price can now, once it gets above this value line, can take off. But we're looking for more symmetry like this. You can see this is what we're looking for. We're looking for nice symmetry. Look, below, above, below, above, below, above. This is nice symmetry. So this would be a nice asset to look for. And if we look at this asset now, we can see that we've got this unmitigated supply zone over here. It's unmitigated, guys. It hasn't been touched. And how did it form? It formed at an apex. See, so usually at these apex peaks, we get these explosive moves. We've also got a 3-drive pattern, which I explained last week, which is nice to keep out. We've got one lower high, 2 lower highs, and usually the third one is where we get the big drop. And it plays out usually very accurately. The first, second, third drop. We call this a 3-drive pattern. It's a very good pattern to keep in mind when you're looking at the market on higher time frames or lower time frames. On the third lower, you can also see we've got a descending wedge. Usually when we've got a descending wedge, you can see it's lower. We got a lower high, lower high. The third one becomes the one where we get this drop. So when you see these bearish patterns, and then if you look over here, we've got this big drop over here. Can you see this big bearish candle? So this is showing us that in this region, we've got tons of imbalances happening. We've got a supply zone. We've got imbalances. We know that price is undervalued over here. You can see we've got price undervalued. So if we look over here, we can see we've got, in this region, we've got demand. This is demand zones in this region over here. So if we had to mark up the chart like I've just marked it up to you, it tells like a very lovely story. We can see we're looking to purchase our buys when price is undervalued. Yeah, guys, like hopefully the story is starting to make sense for you guys. You can see it's undervalued. So we're looking to purchase undervalued when price hits demand. You can see here undervalued. Remember, this has happened a few times already where it's been undervalued and it's come down, hit the demand, gone back up, and then broken up. So we've got the same scenario happening here. Again, undervalue hitting demand zone, undervalue hitting demand zone. If you'd accumulated your inventory over here, you can either trade it back to value or up here, because you can see that this is an area of price is highly likely to go back to within the near future on this token, because we can see we've got a fair value gap over here, and we've got an actual order block over here, and it's underneath value. So we know when price gets above value, the market makers like to take profit. So there's a big chance they could be driving to this region over here. But anyways, guys, that's just the gist of what I was explaining to you, how to understand how to use these higher time frames. I mostly stayed on the higher time frame today because it's something that I really wanted to make apparent to you, is to focus on the higher time frame first. Once you have a very good understanding of the higher time frame, then you can zoom in. I mean, all these areas are marked in green are areas I could have zoomed in on a lower time frame and started looking for nice buy entries following this indicator X strategy. All right, guys, does anyone have any questions on anything I've said today, or just anything where you would like some more clarity? Now's your moment. Let me know.
I've put some questions in the chat box. I don't know if anyone wants to jump in first, but I've got some questions in there we can go through.
Yes, let's go through all of them. Yeah, for sure.
Okay, so I've got a few. There's a couple of other people have got questions in there as well. So I'll go through a couple of mine and then let somebody else have a go. So how and why would you set alerts on indicator X?
How would you set them and why would you set them? Okay, cool. Let me take you to the chart. If you want to set alerts, let's start here. You would
Can I just slow you down just for sorry, Seth, just before you answer these questions. One of my confusions is that when we look at these things in hindsight, you know, you can sort of spot areas of you know, where they're bouncing up and down and coming back to the area and forming patterns and stuff. In real time, though, it'd be interesting to see how, you know, what you're looking for as well. So, you know, how to set alerts, you know, you'd need to know why you're setting the alert. The reason I ask why is how would you know now is the right time in a coin to set an alert? Does that make sense? So the idea in most of these questions is how do you use it in the field as opposed to just understanding what they are? How do you use it in anger, you know, in the field of battle, so to speak?
Perfect. I got your question. Very, very nice question. I'll explain to you super clearly. So if we're looking over here, we can see we've got our contraction, we've got our value line. So if we've got a token like this, there's going to be two places we're going to want to focus on. The first place we're going to want to focus on is when price is breaking the value line. When price is breaking the value line. Okay. So we would want to set an alert in this location, because when we can tell price is breaking value, it's showing us that there's this accumulation and distribution shift happening. The second places we want to focus on is the further away price gets away from the value line. The further away it gets from away from the value line. So if you're tracking a token, you want to track it at these locations. The further away it's getting from the value line, you want to start paying attention. The further away getting from the value line, want to pay attention. Or when price is breaking the value line, you want to pay attention. In order to set alerts for that, if we want to set an alert on the value line, because it's definitely one of those places you want to be alerted. When price breaks on top of or below a high time frame value line, this is usually a good place for us to be alerted. And all you do for that is you just right click and you click add alerts, and then you can select in the options here. You can see we're on option number 3, and we can go major value line or minor value line. You can set an alert for the majors and the minors, and even the origins if you want to just target all the value lines. So what will happen is every time price crosses the value line, you will receive an alert, and that means you'll be able to understand at this region, because these are the regions, are the best places we can look for longs, and these are the best places we can look for longs as well when price is further away from the value line. So if we want to target these regions, what we do is we're looking at previous price history and we're looking for wicks. You can see we're looking for wicks, or we're looking for, and then we're marking out those. And then we're going to set an alert on here as well. I think to set an alert on this, you just scroll. You can see if we look on the corner, there's a little
you just right click and then it's
Yeah, or you just right click here and you say add alert, or I click on here, you just click here, you click add alert. So then we got an alert there. So those are the two locations we want to focus on when price is moving further away from the value line and it's tapping either an area of a lot of wicks or a demand zone. And the same thing up here, when price is moving away from the value line, you can see this would have been the region, but price completely broke through that region. So then we would have waited for, you can see this would have been the point where it topped out over here. We wouldn't have known that. Then we would have seen this big breaks in structures, the weakening of the trend, and then we would have marked out. You can see this would have been an area to look for to catch an entry over here. So, but those are the places. I'll draw this out for you in a nicer way to understand. This is actually in the training as well, the two locations that we look for. So we can see prices breaking out over here. We've got the value line in the center. So our main areas that we want to look for entries are going to be at these breaks, where price is breaking the value line. And remember, this is the higher time frame. This is the higher time frame perspective. And then there's going to be these points where we get the reversals that occur. So the further price gets away, because remember, guys, if we look on a higher time frame, this is we're actually trading a higher time frame expansion leg. Look, these are expansion legs. So we know in a high time frame expansion leg, it goes up, it whipsaws down, and we know when it goes up, chances of it coming back are very high. So then we just want to track this asset. We want to track this asset and notice the further away it gets from the value line, these are the areas we're going to look for these rotations. Price likes to rotate back. So we can either look at previous price action history. These are going to be two different ways. We're going to look at previous price action history for wicks and demand zones. Let's just say like that. And these will become areas where we will set alerts. And the same thing will happen over here. We look for previous high history, because this is how price likes to work, likes to come back to these areas. If there is no previous price action history in that location, then what we're going to do is we'll use our normal strategy of looking at the Heiken Ashi candles. I'll show you over here. So as price gets further away, let me show you. You see I've got here. As price gets further away, let me just go into a higher time frame so I can make it. So here we go. I'm just going to zoom in on both of these so it's super clear. So you can see over here, as price is coming further and further away from the value line, just imagine we had no demand zone. And now we're wondering, how are we going to know when that reversal is going to occur? So we'll come onto the Heiken Ashi, and you can see over here, you can see flat back, gray, 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 gray. And then we've got this indecision, and then we get a flat back bullish candle. That's when the reversal is happening over here at this level. So then we can anticipate that will be the point to enter back to the value line. So those are
very practical.
Yeah, super practical. Does that answer those questions?
It really does answer those questions.
Oh, fantastic.
And you set up these value lines for a time frame of 4 hours and 12 hours. Can you just quickly go and show how to do the 4-hour and 12-hour?
Yeah, for sure. So I'll pick this coin over here. So all I did was I added indicator X twice onto my chart. So you can see I've got it added here and here.
Yeah.
I've actually got it 3 times, but I'm only in this example. This would be the second one here. There you go. I've got it added twice onto my chart. On the first one, I've got it just set to chart, right? Just set to chart, which is I'm on the 12-hour. Well, let's see. Wait, what is the second one? Okay, wait. I think I changed that. So the first one you're on, you want to set it to the 12-hour time frame. Okay. So now I've got that set to 12 hour. So now that will stay on the 12-hour time frame. Oh, wait, so I've got so many on my chart here. I want to okay, I've got one on the 12-hour time frame. So the one is set to the 12-hour time frame. I leave that standard. I leave that on all the time so that I know that my 12-hour one is always on. And then we come on to a smaller one, and the smaller one can be set.
Is that only set to majors or minors or?
This one I've got is set only to majors, because the reason I'm using only the majors,
okay,
is because it was confusing people to have the majors and the origins on.
Yeah.
So I think until you understand it properly, just stick to the majors for simplicity's sake. And then we'll add another indicator X, which is going to be on a lower time frame. And the example I was using was a 4-hour. So this all depends on your trading style. If you are going to be doing like mini swings, then you would stick to a 4-hour. I'd recommend a 4-hour. If you want to do scalping, then this would come to a 15-minute. But for this example, we'll just use the 4-hour. So there you go. So now
And again, majors only on the 4 hours, yeah?
Yes, exactly.
Simple, yeah, fine.
Majors and 4 hours, it's great. It really is great because this will help you. Remember, you wanted to understand how the rotation will occur back to value. So I'll show you over here. So I'm going to mark out the 12-hour value line over here, just to show you how you can use these lower time frames. This is the 12-hour value line over here. In this example, you can see prices coming down away from the 12-hour. So how do we interpret the rotation which happens over here? We can actually use these 4-hour value lines as rotation points. So you can see we got the 4-hour.
Lovely.
4-hour happening here. And then we just wait for it to break a 4-hour value line, which gives us a very, very confident. We wait for it to break the 4-hour value line over here, and then we trade it back to value. Or we can, here it happens again, break the 4-hour value line back to value. Or we can purchase our buy orders underneath the value, but underneath the value, we're still not 100% sure the rotation's occurring. So we wait for it to get on top over here. So this is how you can use them together. They work extremely well together, the higher time frame and the lower time frame value lines in combination.
Thanks, Seth. Very good. I'll let somebody else get a couple of questions in, and then I'll take mine off and take mine further on at the end.
Okay, perfect. All right, guys, anyone else with a question? Let me have a look in the chat, see if there's anything in there. Here's a question. So on a higher time frame, always look for longs under the value line, back up to the value line, or when above. What about on a lower time frame? Yeah, so it's the same thing on a lower time frame. Remember, what happens on the macro happens on the micro. You do the same process happens on the higher time frame that happens on the lower time frame. So if it's a 12-hour, 1 hour, 15, it's the same thing. We're looking for longs under the value line to value. It all just depends on what time frame you're trading on. If you're a scalper, a swing trader, or a higher time frame investor.
You know how Pramod does his, if it's under the weekly, look for shorts. If it's over the weekly, look for longs. Would you do the same similar thing here, so that if on a longer time frame, say the 12-hour, it's below the value line, then you're looking for longs. If it's above the value line, then you're looking for shorts on the shorter time frame. Would that make sense?
Yes, exactly. That's it. That's the exact same scenario. So that's why sometimes people
I might actually be learning something here.
No, you got it spot on. These higher time frame value lines are like Pramod's strategy in the pivots. It's above the higher time frame value lines, so we're only looking for longs. It's below it, we're only looking for shorts. And you can see it works. It's very accurate. You know, like price here.
The other way around. Is it the other? No, sorry, I said it the other way around. You're saying if it's below it, we're looking for shorts. I'm looking for reversals. You're saying if it's below it. Sorry, maybe I got it wrong again. Maybe I'm not learning anything.
No, it's perfect. So imagine the value line is, on Pramod's strategy. He says we've got the weekly pivot. If price is above the weekly pivot, we're looking for longs, right?
Yeah.
So it's the same thing. If we use the value lines are very similar to pivots, actually. They can be used in a very similar manner. If price is, because remember, if you're trading on multiple time frames, so in Pramod's strategy, if price is above the pivot, then you're looking for longs on the lower time frame. If it's below the weekly pivot, you're looking for shorts on the lower time frame. This would be the same thing. If price is below the higher time frame value line, then on the lower time frame we're looking for shorts. If it's below,
I thought you'd be looking for longs as it looking to come back to the value line, Seth.
Yeah, yes,
so
yes.
Maybe I've misunderstood.
No, you are. Remember there's the higher time frame and there's the lower time frame. So on a higher time frame, as price is coming further and further away from value, we're looking to long back to value on the higher time frame.
Okay. But on the
So,
shorter time frame, we're looking for shorts.
yeah, on a shorter time frame, we've got this whole leg. We've got this whole leg, which we could have taken shorts.
Got it. Okay.
You see, so I will keep reiterating over and over, so this makes sense.
You
But
keep
like,
referring to the longer time frame, so then you may then switch strategy on the leg up. You may then look for longs. So if it's below the
yes,
value line, you could be looking for
exactly.
longs or shorts and vice versa.
Because remember, this is an expansion leg. So in our master pattern over here, the key is to understand the master pattern and how when it goes into expansion, we have multi-expansion legs that happen. So can you see we've got these multi-legs, we've got our contraction box that happens, and then we've got the multi-legs here. So what we're doing is we're only trading one of those legs down, anticipating that there's going to be a rotation back to value over here. So we can trade shorts on the leg down, but we got to keep checking on the higher time frame to notice when is the rotation going to occur back. And that is why we can use another indicator. We can use a lower time frame value lines to see that the rotation is going to occur back here.
And then you'd still use the longer time frame to say, now we're going back to value line. Let's look for a long.
Yes, exactly.
Yeah. So
the higher time frame value line will be our main goal of where we know price is going to be attracted back to this level. So we're anticipating the further away it gets, we know it's going to rotate. So when we do our shorts, we can't short for too long because we know that the longer this goes down, there's going to be a rotation. So we're just keeping all that psychology in mind of what's happening behind the scenes.
Love that. Thank you.
Cool. Pleasure.
Yeah, that's in your bread and butter strategy, right? So
yes, that's right.
Yeah, you can find that on the complete method in Discord. It kind of talks about that.
Yes, I go into a lot of detail with images and stuff there.
Yeah. One of the questions
Thank you very much. I'll look at that.
Looking at, Seth, I don't know if anybody else, when you're talking about price action, you're talking about higher lows and lower highs.
Yes.
What I'm trying to learn is the confluent, I can't say that word sometimes, but like when you're looking for those reversals or even those trends with the higher time, the higher lows and lower highs on the on that, I know there's that consolidation phase and the chalks and the break of structures.
Yes.
What is the ones you're looking for to know that there's going to be a reversal or there's going to be a new trend?
Okay, I'll show you. Yeah, for sure. So are you saying, so like as price is going down, how do we know there's going to be where's the point where it's going to turn around and reverse back?
Yeah.
Okay, I'll show you a few different methods to do that. There's one of them we can use the TDIX. You know, as price is coming into these oversold regions, these are places of reversal. That's one method we can do. Another method we can do if we want to get a real structural method, we can actually look here. So what we do is this over here. I'll draw it for you and show. So say price is coming down like this. We're looking for the chalk. We're looking basically for the chalk example to happen. And then we're waiting for price to break these lows, to break above these lows. So we're kind of looking what they call an SR flip. You know, what was resistance becomes support. And you'll see, like, if we mark it out, it kind of happens over here. See? So this is one way to do it. Another way to do it is we can see it kind of happens over here as well. You can see we get this break-in structures over here. This is a break-in structure happening, and then it leaves behind a demand zone over here. If I go into a low time frame, this will actually be a demand zone.
Yeah.
So we can wait for break-in structures back to demand zones. We can wait for a break of a structural zone or a support and resistance flip over here. So we could enter here. We could enter here. This is just using pure price action to figure out these reversals. Yeah. And the good old famous way, we can draw a trend line and we can wait for a break of trend line, which a lot of people use this kind of strategy as well.
Yeah, those strategies are really pronounced in TA, right?
Yes. Yeah, those are pure price action TA.
To the higher lows and lower highs, can that kind of confuse you, or? Because
No,
that's
it,
kind
it,
of where
it no,
I'm at.
it can work. It can work great as well. Like if we look in this example, you can see over here we've got that very thing happening. You can see we've got, this is the lower low, and then over here look, low high, or high low, high low. So you can see from this onwards, you can see from here, you can see there's this upward movement happening. You can see if we had to
Mhm.
draw a trend line, we can see prices actually going up and respecting that trend line. So that's also another way we can do it. A lot of people also do that. You can see this would have been an area because there's no more lower low being formed. So at this point could have been an area where you could have started getting interested to look for your long positions.
Okay, so like you basically look at those for the reversals. Okay,
Yes,
so when a
exactly.
higher low happens, that's more of like a bullish signal versus
Yes, exactly.
bearish signal. Okay,
Yes.
and then the
Your
lower
first,
high is the opposite kind of thing.
yes, exactly. So your first low high here will signal to you that price didn't want to go further down anymore. So it's showing that there's less supply and there's more demand. So these, now you can get interested to start looking for an entry somewhere around this region.
Okay.
And then here you could have drawn, if we draw a demand zone, we can see it ties in with the same thing. We've got a demand zone in this region.
Mm-hmm. And I've
So
noticed demand zones or those demand zones, and then putting your stop loss below the demand zone is probably where you get those
yes,
tight stop losses.
exactly. That would have been a perfect place because if price breaks below these levels, it invalidates the trade anyways, because this is going on the whole basis that price is actually going to stay above here because we're anticipating now there's more demand in the market and less supply.
Yeah, and there's a lot more fake outs these days because of the strategy of the smart money contract, smart money
Yeah,
contract, right?
there is so much. That's why that's why it's so important to have so many of these different strategies under your belt, so that
Okay.
if it's not one way, it's another way. There's many confluences we can use. You can see these wicks over here, like these wicks. These are the wicks that confuse. Sometimes you'll see there'll be a wick and the next one will wick further down, further down. So it doesn't matter how many times you get in, you almost get taken out like every time.
Yeah, that's been my thing is like I'm getting in at the right time, but then like all of a sudden
I
I'll get
know.
wicked out, and then all of a sudden it's like quick reversal. Like,
Yeah, then it goes in your direction that you knew it was going to go in.
yep.
This happens a lot, and sometimes I don't know how to get around it because like if it wicks you out, then you can sometimes lose confidence to jump back in the trade as well. But sometimes the best thing to
100%.
do
That
is to,
psychology
yeah,
kicks in immediately of like,
and then you get a bit
oh,
scared. It's crazy how it works.
yeah. Thank you.
If you have
Yeah.
confidence in the indicators, could you not set a really big stop loss so you don't
Yeah,
have a massive chance of getting wicked out? I mean, if your confidence level's high and it's borne out by stats, then I suppose you could have big stop losses, hoping
yeah.
that you don't get wicked out and avoid getting wicked out so often. And
Yeah, well, the
then
thing is
jump back,
that
and
would be
then
great
you
if you
take it, you
spot
ride it to
trading.
this direction.
It all just
Yeah.
depends also what position size you're in,
Yeah,
because
otherwise you get
if you're in a very
liquidated.
big
Yeah, if you get
position size,
on leverage, you get liquidated.
it's quite scary if you've got a stop loss that will be like a $10,000 loss or something. So
Oh,
like
especially with leverage of 10 times or 20
using
times.
using the risk reward calculator wouldn't matter the distance of the stop, because you would then mitigate your leverage. You could either be 1x, 2x,
exactly,
10x. Because
exactly,
your entry and your stop are what's first important. Utilize the
yeah,
calculator. You're still only ever risking your 1-2% of your account regardless.
exactly. Yeah, so you would just have a smaller position size if you want to have a bigger stop loss.
Can I jump in with a couple more and then we'll take more from the chat? Is that okay?
Yeah, for sure.
When and why does the value line expire? At some point, the value line stops going to the right. Is there a defined reason why that happens? Is it because another value line takes over always, or is it because of some other reason?
Yeah, it's basically every time there's a contraction. So the contraction is the box. This is the first phase in the
Yeah,
market,
that's the box.
and then
Yeah.
we get the expansion. Then when another contraction starts, it means that this cycle is over. Now there's a new cycle starting.
Fine. Very clear. very clear.
So it's just
And then-
representing cycles.
Great. And then you were talking about the symmetrical patterns, it goes up and down, up and down. I would just,
Yes.
and you're saying that's you can spot that. My feeling is in the heat of battle, by the time you've spotted it and feel it's forming this range, it can change the range, right? Is that, do you know what I mean? By the time you see it hit it twice, so, going up and down in the same direction, by the time you suddenly go, right, I'm going to trade this range, it could easily break out. So it's not definitive that you spot the range, you spot the pattern and then go, I'll trade the pattern, right?
Yeah, it's never going to be 100%. But what I was saying is when you're picking a coin to trade with this method, you'll go through, and I would be looking for coins that have higher time frame symmetry on them. Like some coins have better symmetry than others. Some look like not symmetrical at all. So like if you had to go through like 100 different coins, and you would see some like for instance, okay, I'll show you exactly what I mean. So if we had to come back into time over here, this one over here is looking very symmetrical. I'm waiting
does, yeah.
for. We'll go back a little more. So if we had to see this is looking lovely, because you can see price came down over here, came up, and came down. This is a very nice symmetrical one to trade. So symmetrical ones to trade, they also have very nice, let me just put this on a 10x. They have very nice outcomes. They respect the symmetrical form. So you see, if we can catch a symmetrical one, producing the symmetrical ladder, then we know symmetry is going to come back, symmetry is going to come back down. So we're just looking for an asset that's more looking symmetrical within the expansion phase over one that's looking a bit like it's not respecting, because you can see, look how nicely this respected it. Very nicely came down. Such a nice, perfect expansion phase.
And then but then it stopped quite abruptly, didn't it?
Yeah, then it came down, and then it started a new phase over here.
Yeah.
And it was still pretty symmetrical, this new phase.
But it only did it once. Where you were talking about where you took your time back. It only did it once, and then that was the end of that, wasn't it? You couldn't have traded it a second time.
Yeah, well, the thing is, you want to keep in mind
that job done.
Yeah, that when we're in the expansion phase, we have an average of 3 to 7 of these whip fours before it deviates away from value. So you'll see here we had 1, 2, 3, 4, and then it deviated from value. So if we can catch it on the first, let's say 1, 2, and 3, we have a great chance of riding it back to value. After 3 or 4, we start losing the probability in our favor and of it deviating
That's
away.
Good to know. I'll let somebody else get a question in before I take my final couple.
Seth, just a quick one here.
Yes. Hey, Salah.
Hi. So I'd like to know your configuration, the settings you've got on the indicator X, please.
Okay. Yeah, at the moment over here, I'm only on the higher time frame, and I've got a 12-hour set, and only on the major master pattern. And then I've set here, I play around with these quite a lot. A lot of people are always asking me for like settings on the contractions, and I do change them from time to time because they operate differently on different charts. But if I had to keep it set onto one setting, to keep things simple, I would leave it on a 2-2 on a higher time frame and a 3-3 on a lower time frame.
Okay.
But I like to open the chart and have a look. Sometimes it's something that you can play around with, but I'd keep it just set so you can see if the higher we go, the bigger it'll incorporate the bigger swings. The lower we go, the more master patterns it will incorporate as well. So it also depends, but I'd say just leave it on a 2-2 on a higher time frame.
So you selected option 3. So was it the multi-bar master pattern?
Yes, that's right. Yes, multi-bar master pattern, 12 hours, and then just putting on the major master pattern setting, and then a 2-2 contraction.
Okay, super. Thank you.
Yeah, pleasure.
And thanks for sorting out the other thing as well. earlier.
Oh, pleasure, man. Anytime. Anytime.
All right, cool.
Hey
Oh,
Seth,
hi, Seth.
how are you?
Yeah, good in yourself.
Yeah, very good. Thanks a lot. Thank you so much for the session. It was really, really good. I have a question whether we could chart ETH using this
Yeah,
for
yeah,
entries as
definitely. it's
approaching 4K right now. And I'm curious
Let's
what
have
you're thinking.
let's have a look at ETH right now and see what's going on. 12 hour. Yeah, look at that. I mean, this would have been a great entry here. You can see it broke the value line. It kind of popped off the chart. Let's look on a higher time frame. Yeah, look at that. It just broke a nice 2-day value line over here as well. So now this becomes a very strong resistance point underneath here. And I think it looks pretty strong. Looks like ETH wants to take off actually. Is there no more? Oh, there we go. Okay. Yeah, so if we look over here, we've got higher time frame resistances. So there's not much stopping it once it breaks this level. Like it could shoot up here. There's not really much resistance anymore on ETH, to be honest. Yeah, there's not much resistance.
Okay.
Now you
Okay,
see,
cool.
there's on this chart, there's no value lines anywhere higher because we kind of gotten so high up. It's literally above. If I like to always mark out the other value lines because value lines can act as resistance points. So if you mark them all out over here, you can see price has actually gotten on top of all of these. So it's pretty much there's no new value lines higher than where it's at right now. It's almost in like a value discovery area.
Cool, thank you.
Cool.
You had a question from, I think, El Chile. It's how would we know if it's going to bounce off value line or break through?
You don't know. You would have to just observe to see how it reacts. So if we look at this over here, we can see price came back to the value line. I didn't know, we would never know if it's going to bounce, but if you see, we've got a reversal candle. So we can always look at the candle that's being presented. This is an evening star candle, which is actually a reversal candle. So all we have to do is just observe when price comes to the value line, like how is it responding to the value line? Is it rejecting into it? And then if we see it rejecting, we can look for shorts. If we see it break above and find support, we can look for longs. So we're just observing how price is responding when it gets to the value lines.
And my last couple of questions, if everyone's asked their trading questions, I've just got a couple of other questions which may help you.
Yes.
Would you, I know you've asked for some help with video testimonials. Do you need any more, or are you done? Are you had enough?
I've received 3 testimonials, and if people are willing to do more, I would highly appreciate it.
I'll happily do one for you.
Oh, thank you
The
so
next
much,
one
Gordon.
similar to
Really.
that. No worries at all. The next, and I'm hoping some other people here may be willing to do that as well if they're happy with the trading and the training. So I'm sure when you ask here live, you might get a good response as well.
Yes, thank you for bringing that up.
Sure. The other question I had, on the similar vein, was you posted a YouTube video. I'm just wondering if anyone here hasn't seen it on YouTube. It's a training you did, I think, with Whale Room.
Yes.
They may want to watch it and comment. Yeah, may want to watch it, click like on it, try to get more YouTube views on it. That's a good thing to ask for. If you ever post anything on YouTube, just ask the community to go in and post likes and comments on it, because then that
Yes.
brings
share.
more YouTube visitors. Yeah, and share it. That brings more
Yes.
YouTube visitors to your platform.
I think that
I'm sure you already
was-
knew that, but yeah.
No, it's a good point. I didn't think about doing that, to be honest.
Well, the issue there is I believe that those, you see, even all our live trainings are on YouTube, but they're private, just for us to get to. They're actually hidden videos. I don't believe
I think there was one that was public. Wasn't
Yeah,
the one with,
I loaded a public one.
Oh, did you?
Yeah.
Okay, sorry.
Yeah, I loaded it yesterday. It was I've
Yeah,
got
the
a few
private
other
ones,
ones
yeah,
which I'm
fair
going to
enough.
load publicly as well. I'm busy creating a bunch. So I'll
Yeah, I think it's
definitely
worth
let you guys
doing.
know.
And if I may just suggest, I know you may have a business, very, very hot business decision why you don't want to do this, and that's absolutely fair enough. That's your thing. But 3 days, even though I took a 3-day trial, I was just thinking, God, what can you actually learn in 3 days? You may
Yeah.
want to just consider extending it to 7 days because it's neither here nor there to you, I would imagine. And
Yeah.
then people get 4 days of your, excellent training. They get 4 days of PowerFriend doing his lives, his live
Yes.
voice chats.
Okay,
They
I
get a
see.
whole lot
I
of
see.
community stuff. You may, I don't know, but you may find people are
No,
more willing
thank
to
you.
take a
Thank you for that.
7-day trial than a 3-day trial. 3 days just sounds, by the time I open it and get to know it, it's going to be ending. That's what I thought. And I just jumped straight in. I did the 3-day and I thought, I'm just going to go for it, even though I hadn't learned enough to make a decision. I just thought, I trust there is going to be enough because I heard good
Yes.
stuff about it. So just in case, and then
No,
you've
that's
got
a
other
very good
social,
point.
and then you've
Thank
got
you.
some other social media channels, people here, if you post the link here, while at the beginning of or the end of this, or when Q&A starts, they may be willing to just go in and do what you want them to do while they listen to
Yes.
the Q&A,
Oh,
just, just to get
yes.
your engagement, because people here are engaged because they're listening to you. They're,
Yes.
they're influenced by you. They like what you do. You get good feedback.
Yes.
Why not? Why not just capitalize on that? And I'm sure no one minds. I know I certainly
No,
wouldn't.
that's brilliant,
And
Gordon. Thank you so much. Sure. So maybe next time I do a video, like a training, I'll just say, guys, if you wouldn't mind just giving this video a quick like, really appreciate it. I'll post the link in the comments or something.
yeah, and on Pramod's session, PowerFriend could do that as well.
Yes.
If he's
Yes.
there, then he could
Yes.
do that. So yeah, it's all, it all helps the algorithm find you
Yes.
and put
No, it
you
helps a
higher
lot.
up the
Yes.
charts.
And we've got a lot of people in our group. So if it's 20, 30 or 100 people, it really makes a difference if they like it or
Yeah.
comment on it or watch it.
Sure. There you go. That's my.
Seth, I don't know if you
Yes.
wanna. Can you have a look at TRX,
Sure. Let's have a look.
please?
Let's see TRX. So you can see over here, it's broken below value. So this would be a time where you would actually start anticipating somewhere around here that there's going to be a reversal back. This looks, you can see that.
I've jumped in already.
Okay, yeah, it could be now. It really could be now. Let's have a look.
Yeah.
Look here.
Yeah. I put on the ATR, and it looked good.
It looks good to me as well. This was the exact thing I was talking about. As it goes, which time frame were you on the ATR on?
So I put.
I've been playing with my settings so much, just back testing this. Okay, yeah. Which time frame are you on? A 4-hour?
Got Confluence with 4. So the RSI, it's got a couple. So
Yeah, it looks good.
I'm just front running it a bit, and if it goes down a bit, I'll add a bit more.
Yes. No, it looks very good to me. It's in a very good zone. It's like it's a discounted zone over here. And yeah, look, you've got some good, you can trade it back to value. You've got 10%. I think you got a good entry. So this is exactly what Gordon was saying before. How do you know? So you can see Gordon, the further away it's gone from the value line, he's anticipating to trade it back to value line. There's also, you can see there's demand zones over here. I think it's a good one, man. Yeah, let us know how it goes.
Good one.
Thanks,
Thank
will
you
do.
very much for bringing that to our attention. Well done.
You're welcome. Thank you.
All right, guys, I think I'm going to call that a night. Go get a nice dinner now. But thank you so much for being here. Thanks for your great ideas, Gordon. Really appreciate them. Definitely taking them to heart. And yeah, thanks guys for tuning in. Take it easy, have some good trades, and we'll see you in the group. Also, just
Join us
letting
at
you
the
guys
voice.
know, if you want to continue this, Power Friend will open up a voice chat in the group if you guys want to continue chatting and carrying on the good stuff. Yeah, take it easy.
Thanks, Seth.
Thank you, Seth.
Thanks, Seth. Appreciate it
you.
again. Another great training.
Yeah, pleasure, guys. See you in the group. Ciao, ciao.
Thank
Bye.
you.